What if I told you the fastest way to buy a $2 million apartment building is to show up with no W-2, no tax returns, and like a credit score that traditional banks would openly laugh at?
I mean, it sounds like a complete scam.
Right. It sounds like a total scam.
Bro.
Or maybe some relic from the 2008 financial crisis.
Oh, yeah, totally. But it is actually the standard operating procedure for some of the most successful property investors in the country today.
Which is just, it's wild to think about. Welcome to today's deep dive, everyone. We are exploring the high-stakes, hyper-fast world of real estate investment for you today.
Specifically, we are looking at how investors actually fund those massive, multi-million-dollar property deals when traditional banking channels just say no.
Yeah, and we have a really fascinating stack of sources for you. We are looking at articles, market insights, and blog posts written by John Constantine from a firm called San Diego Hard Money Lender.
And, the material from Constantine's firm offers this rare, really mechanical look at the engine of private capital.
It really does.
It strips away all the mystery of how developers actually finance these massive neighborhood transformations that we see happening every single day.
So our mission for this deep dive is to basically decode this often misunderstood world of hard money lending. We want to break down how speed, leverage, and asset-based financing can unlock massive real estate potential.
Right, and we'll look at the underlying math of these deals and why your personal income verification is entirely irrelevant if you just understand how to evaluate an asset's future value.
Exactly. But to figure out why this unconventional funding even exists, we first have to look at the environment that forces it into existence. And our sources point us directly to the market in San Diego, California.
Yeah, San Diego serves as a perfect crucible for this whole discussion. I mean, you have a few colliding factors creating a severe market squeeze right now.
Because the population is rising steadily, right?
Right, the population is rising. There are these entrenched geographical and regulatory limits on building new sprawling subdivisions. And so, consequently, there is a massive housing shortage.
Which just drives up rental demand to crazy levels. It's like the classic supply and demand nightmare for a buyer.
Oh, absolutely. More people competing for fewer doors.
And the sources highlight specific neighborhoods, right? Places like North Park, Hillcrest, and Chula Vista.
Yeah, those areas are experiencing a modern gold rush.
But this is where the traditional banking system completely breaks down. Like if you drop a conventional 30-year mortgage application into this specific environment, it is just a fatal flaw.
Because traditional banks are agonizingly slow. I mean, we are talking 45 days minimum just to get to the closing table.
Which feels like an eternity in real estate.
It is. The psychology of a traditional bank underwriter is inherently backward-looking. They want to underwrite your past.
Right. They need years of tax returns, months of bank statements, W-2s, debt-to-income ratios.
Yeah, that forensic audit takes weeks. But when an undervalued, distressed property hits the market in a hyper-competitive neighborhood like Hillcrest, the seller does not care about your pristine financial past.
They usually just want out immediately.
Exactly. The window to acquire that asset is measured in days, not months.
So think of this real estate market like a high-speed cutthroat auction. You are standing there, you see the perfect undervalued item come up, but you have to pause the auction, step outside, and spend 45 days asking your loan officer for permission to raise your paddle.
And by the time you get back, the item was sold 6 weeks ago to someone who brought cash.
It's long gone.
That structural delay is exactly why investors abandon traditional banks. Furthermore, a traditional bank might look at a property that needs a new roof and a total gut renovation and simply refuse to lend on it.
Because banks want turnkey, livable homes.
Right. They run terrified from a house with no drywall, so that the investor is left with a dual problem. The bank is too slow to win the bid, and they're too risk-averse to fund the necessary repairs.
Which brings us to the alternative vehicle, the hard money loan. And I have to say, the name hard money has always sounded slightly illicit to me.
It does have that vibe, doesn't it?
Yeah. It paints a picture of someone showing up with a briefcase full of non-sequential bills in a dark alley. But the sources define it purely mechanically. It just means asset-based lending.
Yeah, the focus shifts entirely from the borrower to the hard asset itself.
So a hard money lender doesn't care about your W-2 at all?
Not really, no, because they are underwriting the future, not your past. They are looking at what the sources call the ARV.
The after-repair value.
Exactly. They are calculating what a distressed, unlivable duplex in Chula Vista will be worth after you have poured capital into modernizing it.
And because they are focused on the math of the building rather than a forensic audit of the borrower's life, The speed is just jarring. The sources show these loans can close in as little as 5 to 14 days.
Which is incredible. Closing in 7 days gives the investor a massive tactical advantage.
Because to a motivated seller, a 7-day close with hard money looks functionally identical to an all-cash offer.
You hit the nail on the head. It allows the investor to skip to the front of the line, just bypassing all the traditional retail buyers who are stuck waiting on 45-day bank approvals.
But wait, I'm doing the math here, and I really have to push back on the economics of this strategy.
Okay, let's hear.
Because I'm looking at the sources, and they openly state that the interest rates on these hard money loans are higher, like sometimes significantly higher than traditional bank loans.
They definitely are.
Plus, they charge origination points up front. So if I am paying a massive premium on my interest rate, my profit margin is shrinking by the day. Why would any smart investor volunteer for a more expensive loan?
It's a great question. But the higher interest rate is basically the cost of admission to the transaction. If you try to use cheap 6% bank money, you lose the bid entirely, and your profit is zero. But more importantly, this brings up the concept of capital velocity and the total cost of the project. Professional investors do not measure the success of a deal purely by the interest rate. They measure it by the acquisition discount.
Okay, walk me through a hypothetical on that for a second. How does the discount offset, a 12% interest rate?
Sure. So let's say a distressed property is listed at $600,000. A traditional buyer comes in and offers the full asking price, but they need 45 days for bank approval.
Right, and the offer probably falls through if the appraisal comes back low.
Exactly. But you come in with a hard money loan and offer $550,000. But you can close in 7 days with zero contingencies.
Oh, wow. And the seller takes your lower offer because it is a guaranteed immediate exit.
Bingo. You just secured a $50,000 discount on the purchase price.
That makes total sense. So even if my hard money loan cost me an extra $15,000 in higher interest over a 6-month renovation period, I am still $35,000 ahead because of the massive discount I negotiated up front.
Precisely. The speed literally pays for the expensive loan.
It more than pays for it, honestly.
And regarding capital velocity, you have to remember, hard money loans are short-term instruments. You aren't paying that high interest for 30 years.
Right, it's temporary.
You hold the loan for 6 to 12 months, renovate the property, force the appreciation, and then you exit the loan. You can cycle that same pool of capital through 3 different properties in a single year, multiplying your returns.
Whereas traditional banking just traps your capital in one slow-moving asset. Okay, the math on the acquisition makes total sense. Speed buys the discount covers the rate.
Exactly.
So let's talk about where this expensive, fast capital actually lands. Because according to the sources, in a tight, expensive market like San Diego, the smart money isn't chasing single-family starter homes.
Yeah.
It is overwhelmingly moving toward multifamily properties, so duplexes, triplexes, and apartment complexes.
Yeah, the shift toward multifamily is heavily driven by lender psychology and risk profiles. How? Well, a traditional bank underwriting a single-family rental views it as a binary risk. We have one family living in the house. If they lose their job and stop paying rent or they move out, your property is instantly 100% vacant.
Right. The income drops to zero overnight, but your mortgage payment remains exactly the same.
And that concentrated risk profile terrifies commercial lenders.
But if I buy a 10-unit apartment building, the math changes entirely, right? Like if one family moves out, I still have 9 other families paying rent.
Exactly. Your vacancy rate is only 10%. The building continues to generate more than enough cash flow to cover the mortgage.
It behaves much more like a stable small business than a risky consumer purchase.
Which is why private capital flows so freely into the multifamily space. The risk is diversified across multiple income streams.
That makes a lot of sense. And the sources outline specialized loan products designed specifically for this asset class. Like the most common is the fix and flip loan, which is structured to fund both the purchase and the heavy renovations required for these older multifamily buildings.
Yeah, and the structure of these rehab loans is fascinating. The sources note they often provide up to 90% of the purchase price and 100% of the rehab financing.
But they don't just hand the investor a $200,000 check for renovations on day one and cross their fingers, right?
No, they would be crazy to do that. They use a system of draws.
Tell me about the draws.
The draw system is the lender's primary risk mitigation tool. If they hand over the entire rehab budget up front, the investor could mismanage the funds or simply walk away, leaving the lender with a gutted building worth way less than the loan amount.
So instead, the funds are held in escrow.
Yes. As the investor completes a specific phase of construction, say, finishing the plumbing, an electrical rough and a third-party inspector comes out to verify the work.
And only then does the lender release the next draw of capital to pay the contractors.
Exactly. It forces the investor to actually build the value into the property step by step. The lender's exposure only increases as the physical value of the building increases.
The sources also mention ground-up construction loans for developers building brand-new rental communities on empty lots, which operates on a very similar milestone-based draw system.
Yes, same basic concept.
But the loan product that really stands out as a unique strategic tool is the bridge loan. Let me try an analogy here for you. A bridge loan seems to function as the financial scaffolding of a real estate deal.
Oh, I like that. Scaffolding is a great way to picture it, because a bridge loan is fundamentally about structural timing and temporary support. In real estate, timing is often the hardest variable to control.
Right, because let's say you find an amazing, undervalued fourplex in North Park, but all your liquid cash is currently tied up in another property you are trying to sell.
A very common scenario.
If you submit an offer on the fourplex that says, I will buy this, but only if my other property sells first, that is a contingent offer. And in a hot market, a contingent offer goes straight into the seller's trash can.
Yeah, because you are asking the seller to take on your timing risk.
Exactly. So how does a bridge loan fix this?
A bridge loan removes that contingency entirely. The hard money lender provides a short-term loan, usually lasting 6 months to 2 years, secured against your existing assets or the new purchase.
It gives you the immediate liquid capital to buy the North Park fourplex today as a non-contingent cash buyer.
The scaffolding holds the new project up. You secure the building, renovate it, get tenants in, and then once your old property finally sells, or once you secure permanent financing for the fourplex, you pay off the bridge loan.
You take the expensive scaffolding down, and the newly stabilized asset stands on its own.
It bridges the gap in liquidity. But you hit on the critical friction point just now, taking the scaffolding down.
Right.
Because these bridge loans and fix and flip loans are built on 10 or 12% interest rates. They are designed for speed, not sustainability.
Exactly. The clock is ticking loudly. The interest payments will eventually bleed the investor dry if they hold that loan too long. So how does an investor actually escape the high-interest trap? How do they transition from these aggressive short-term acquisition loans into long-term wealth generation?
This transition is really the core of professional portfolio building.
Yeah.
The investor's primary goal, once the property is renovated and fully rented, is to refinance out of the hard money loan.
And the sources highlight the most powerful tool for this exit strategy, which is the DSCR loan,
Yes.
the debt service coverage ratio loan. Let me guess. Debt service is just the banking term for the monthly mortgage payment.
That is the core of it, yes. And the coverage part is the math of how well the property's rental income covers that mortgage payment.
Okay.
This is a long-term, 30-year fixed loan designed specifically for rental properties. And the breakthrough for investors is that a DSCR loan qualification is based entirely on the asset's cash flow, completely ignoring the investor's personal income.
I really want to make sure we nail the mechanics of this for you because this is the aha moment for how these empires are built without W-2s.
It really is.
Let's run the numbers. If the monthly mortgage, the debt service on my newly renovated duplex is $2,000 a month, and I have tenants in there paying $2,500 a month in rent, my coverage ratio is 1.25.
Right. The income is 125% of the debt.
Okay.
Lenders typically require a minimum ratio of 1.2 or 1.25. Because the property generates enough cash to pay its own mortgage, with a 25% safety buffer left over, the loan qualifies itself.
That is amazing.
The lender does not care if you lose your day job tomorrow because you aren't paying the mortgage. The building is paying its own mortgage.
The building is its own employer. The asset stands completely alone. And the sources explain how investors weaponize this DSCR loan using a strategy called the BRRRR method, right? BRRRR. Buy, rehab, rent, refinance, repeat.
Yes, the BRRRR method.
This is how you scale from one duplex to 20 apartment buildings.
It is the blueprint for infinite capital recycling. It combines every tool we've discussed so far into a single repeatable loop.
Let's walk through the full sequence to see how the capital actually moves. Let's say I'm a self-employed contractor. I have cash, but I write off all my business expenses, so my tax returns show very little personal income.
A traditional bank will not touch you.
Right. So first, I use a 14-day asset-based hard money loan to rapidly buy a distressed empty fourplex. That is the buy.
The lender funds the purchase based on the future ARV, completely bypassing your lack of a W-2.
Next, I use the draw system from that same hard money loan to gut the units, put in new kitchens, and force the value of the building up. That is the rehab.
And the property is now modernized, safe, and highly desirable.
Then, I lease all 4 units at premium market rates. That is the rent. Now the building is generating serious, verifiable cash flow.
This is the friction point where you must exit the expensive hard money loan.
Right. So I bring in a long-term lender for the refinance. They look at the strong rental income, calculate a healthy DSCR ratio of 1.3, and give me a 30-year fixed mortgage based solely on the building's performance.
They pay off the hard money lender.
And because my renovations pushed the property's value significantly higher than my original purchase price, I can often pull my initial down payment back out in cash during the refinance.
You extract your original equity, but you still own the cash flowing asset.
Which gives me the liquid capital to execute the final R repeat. I take that same original pool of cash and go buy the next distressed building down the street.
It's a beautiful system.
I haven't used a single tax return or W-2, and I've recycled my capital to acquire a massive asset.
And for listeners who are self-employed but maybe just want to buy a primary residence, the sources also note these specialized lenders offer bank statement loans.
Oh, how do those work?
Instead of demanding tax returns, which self-employed people naturally optimize to lower their tax burden, the lender just analyzes 12 to 24 months of actual deposits flowing into your business bank accounts to verify your true cash flow.
It is a financial system built for performance and reality rather than bureaucratic box checking. It treats real estate as a business operation, focusing on cash flow, forced appreciation, and structural leverage.
Absolutely.
So let's pull all these threads together. We started by looking at the fatal flaw of the traditional banking system. It is agonizingly slow and obsessed with your financial past.
And in a hyper-competitive market like San Diego, that sluggishness guarantees you lose the deal.
Asset-based hard money lending solves this by trading a higher short-term interest rate for incredible speed and the negotiating power of a cash buyer,
which allows investors to secure undervalued, distressed properties, primarily in the multifamily sector, where the risk of vacancy is diversified across multiple units.
They use specialized tools like fix and flip draws to protect the budget and bridge loans to act as temporary financial scaffolding.
And once the asset is stabilized and generating strong rental income, they use the DSCR loan to refinance into long-term fixed debt,
completely bypassing personal income requirements because the building pays for itself.
It is a highly efficient, closed-loop system for moving capital into real estate, forcing appreciation, and scaling a portfolio.
And for you, the listener, understanding these mechanics is crucial. This isn't just an insider playbook for real estate tycoons.
No, not at all.
This is the literal blueprint for how wealth, neighborhoods, and housing supply are built in modern cities. It demonstrates that capital is almost always accessible if you understand how to evaluate and engineer an asset's future value.
You do not need a pristine corporate resume to build an empire. You just need to understand the math of the asset and the velocity of capital. Recognizing how capital evaluates risk is the ultimate advantage in any market.
Absolutely. But before we wrap up today, I want to leave you with a final thought to mull over. We've spent this entire deep dive looking at how these hard money loans empower developers.
Right. They provide the necessary capital to build brand new apartment complexes from the ground up, and they allow agile investors to take unlivable, distressed buildings and turn them into premium rentals.
And the sources argue this aggressive deployment of capital is vital for increasing the housing supply in squeezed markets like San Diego.
By bringing dead properties back online and funding new construction, the absolute number of available units does increase.
But consider the flip side of that hyper-efficiency. Agile professional investors are constantly armed with this fast private capital. They are using it to outmaneuver traditional homebuyers, snapping up distressed properties in neighborhoods like North Park and Hillcrest in 7 days.
Long before a normal family can even get a bank underwriter on the phone.
Exactly. It begs a difficult structural question about the evolution of our cities. Is this specialized lending ultimately helping to solve the housing shortage by maximizing density and repairing broken homes?
Or By continually upgrading these units into premium top market rentals, is this high-speed capital just accelerating the gentrification and pricing out of the average resident?
It highlights a profound tension in urban economics. The mechanism that improves the physical building is the exact same mechanism that changes the economic makeup of the neighborhood.
Buying a house used to be a slow, careful procession. Now it is a high-speed sprint fueled by private capital.
The system is incredibly efficient, but the question remains, who exactly is winning the race? Thanks for joining us on this deep dive. We'll see you next time.